In this video, I'm going to lay out for you how to reduce your risk of bad investments. I'm going to help you and teach you how to make informed investment decisions. And then number three, I help you identify potential problems early on. This whole process is called deal underwriting. Get used to that word. So by the end of this video, you're going to come away with the 6 most important things you need to have when you're evaluating or analyzing any commercial or multifamily property. Let's get started. Let's get started right here. How I'm going to lay this out for you is I'm going to give you the 6 building blocks to underwriting right here. I'm going to give those to you, okay? What I'm not going to do in this video is go in depth into the actual numbers. So instead, I think I can do you a better service by having you watch these 2 videos if you want to jump into the actual numbers. These 2 videos will set you up for success. The first video, and the link will appear on the screen, 3 simple steps to evaluating multifamily in 5 minutes. That's right, just 5 minutes. And then the second video, 3 keys to buying multifamily right. Again, these 2 would set you up for success and make even this more important. Let's get started with building block number 1. Here we are with building block number 1 for underwriting your deal. Okay, number 1, the first building block is to get the rental income of the entire property. Now, here's what you need. You need to get 2 things. Number 1, you need to get what we call a current month rent roll. A rent roll is a register or a list of who the tenants are, what units they occupy, when they moved in, and what the rents are. Okay, so a picture of a typical rent roll will appear on the screen so you can see exactly what it looks like, because that's what you need to get. Okay, all right, and the key here is current month. Make sure it's not from 3 months ago or last year. That doesn't count. Do not use that. It's not valid to use. Number 2 is get what we call a trailing 12 months of income expenses. That means if you have your deal today, whatever month is today, you want to get at least 12 months, going back 12 months of income expenses leading up to today. Okay, so the top part of the page will have the income and the bottom part of the page will have the expenses. So get the list, a picture of a typical T12, we call it a T12, trailing 12, will appear on the screen. So again, you can see exactly what you need to get. Now, as I promised you, I want to share with you what to look out for, okay, to make sure you're building this block correctly. I call this what to put your eyes on, okay, be very particular, okay? Number 1 is to make sure you receive actual, instead of fake, okay, actual seller income and expenses. What I mean by that is when you request these 2 items and it says on those items, if you collect a rent roll or a income and expense statement and any of the verbiage on top of the page says Proforma, or it says the word projected or scheduled, it means it's fake. Okay, do not use it. You need to go back to the seller, go back to the agent and ask for the actual numbers from the seller, not something a broker or seller just put together. Okay, you want the actual numbers. Okay, all right, so that's building block number 1 is to get the rental income. Let's go on to building block number 2. Building block number 2 is for you to get the property's operating expenses. Operating expenses are the expenses that occur on the property. It does not include the mortgage. It does not include depreciation. It includes the property's expenses like insurance, taxes, repairs, maintenance, utilities, management, okay, landscaping. All of those are operational expenses. And what you need, again, from building block number 1 is you need to get a trailing 12 month of income expenses, and in that report will be 12 months of what the seller spent on the property. Again, we call this a T12, okay? Now, what you do with that is you need to compare the T12, okay, to the actual bills paid by the seller. What I mean by that is, quick example, is if the seller is showing on the T12 that he has paid $10,000 towards electrical, you need to get $10,000 worth of bills from the seller showing you $10,000. And the reason why is Again, what to put your eyes on is sellers lie. That's right. Sorry to say that, but sellers lie and they leave things out. Okay? Their property may have incurred $15,000 of electrical expenses, but the seller only reported $10,000, off by $5,000 on purpose to give him a higher NOI, a higher deception of cash flow, so you will buy the property. Okay? And this leads to building block number 2 is the number one cause of beginners failing. It is. Okay? After 25 years of doing this, it's the number one cause of failure with beginners because they underestimate what a property's expenses are because they don't have the experience. They haven't done it. So the solution is to get help. Okay? Don't try to do this part by yourself. What we do when our students get a deal under contract and going through due diligence, we have a table of expenses of around the country, what utilities should cost, what taxes should be, what repairs should be, what the total operating expenses for each property size in every part of the country. And you know how we got that? Through 25 years of doing deals around the country. That's how we have it. So this is how we help our students. And so the solution is to get help with this, okay? Get our help or get someone who's been there and done that for many, many years so they can confirm your expenses, because this is the number one failure of beginners. All right? Okay, that's building block number 2. Let's go on to building block number 3. Here we are with building block number 3, and that is calculate project costs. What is that? That is, here it is. There is always money you have to spend after closing. The reason why I have that there as building block number 3, which is so critical, is most investors think after they close their deal, they put down a down payment and they're going to begin the cash flow. That never happens. It never happens because when you buy the property, there is always money you have to spend on deferred maintenance, right? Something needs to get fixed that the previous owner didn't spend money on, so you have to fix it up. You need money for that. You may need to do interior renovations when you re-rent a unit. You may have a couple of vacant units where you want to renovate, put new kitchens, bathrooms, or paint or something. You need money for that. And then also number 3, CapEx, or it's called capital expenditures, that you're going to have to save for later. These are like roof, HVAC, parking lot, and so forth. These 3 things, if not calculated at the beginning, can, again, this whole video is about helping you make informed investment decisions. If this is not calculated, you're in for a big surprise. Okay, big surprise, and it could lead to very, very poor returns and frustration if you don't have building block number 3 calculated while you're doing your analysis or evaluation. Got it? Okay. All right. So here's what to put your eyes on. Okay. Number 1 is, well, this is just one. Have these project costs. Okay, these project costs in hand at closing. Okay, paying for these items from cash flow takes too long or never happens. Okay, so if you have deferred maintenance, you want to do renovations, for example, don't rely on cash flow to pay for these things because they take way too long and you're leaving money on the table, or they never happen because you're carrying these deferred maintenance from cash flow. Okay, got it? So number 3, calculate your project costs, and at closing, have it in a bank account so you can start on these items right away. Got it? All right, let's go to building block number 4. Welcome to building block number 4. This is the fun stuff, okay? Building block number 4 is to calculate your Proformas. Proforma are forecasts. Proforma means to project forward, okay? Best case scenario. And we love that because when we can project a great future, like a higher NOI down the road, not only do we have higher cash flow, we also have higher values. So one of the beauties, again, of commercial real estate is we get to force the appreciation and create great cash flow and great wealth that way, okay? So this is the fun part here. All right, so when calculate your Proforma, I just want you to basically focus on 2 things. I'm going to keep it simple for you, is to have you answer the question, where can I take my rental income up to in 3 years or 5 years? Okay, it's going to take you to move tenants around, renew leases, renovate units, but what can you do to get the rents up to in 3 years or in 5 years? Okay, question number one. And question number two I want you to answer is, what is my 3-year or 5-year projection for my NOI? Okay, as you remember in commercial, as you raise the rents, you raise the NOI, you also get to force appreciation. Again, my favorite part of commercial, right? You can't do that with the residential. Commercial all day long. And here's what you have to put your eyes on though, okay? So for years, when we run deals, when our students run deals through us, when we increase the income, we also have to put in an increase on expenses because it just happens, okay? For the last few years, we've been using 2% for many years, okay? Just an automatic 2% no matter what. The expenses are going to go up. Well, guess what? Inflation, higher property taxes, our insurance has tripled, labor costs have gone up. We're kind of out of control here, right? So what we have to do is accommodate our underwriting for that occurrence. And what we have to do now, today, the minimum overall annual increase is no longer 2%, it's 3% or more. Okay, it just depends on what's happening on the property. Okay, again, these are operating expenses. Okay, this is not anything to do with your finance or your depreciation. Only operating expenses. So use 3% now. And the reason why is because your expenses affect your NOI. So the higher your expenses, the lower your NOI. So if you're increasing your NOI here, you're also increasing your expenses down here to make sure you're as accurate as possible when you're underwriting a deal. Got it? All right, let's go to building block number 5. Here we are with building block number 5, and it's really, really important. This is the bread and butter of your building block. Okay, this helps you determine your cash flow, your return on investment. So this is really, really important. Building block number 5 is how you're going to finance your deal, i.e. your loan, okay? Now, your financing is important because it determines your cash flow and your cash on cash return, your return on investment, okay? I call your cash flow and your cash on cash return the 2 pillars of decision making, whether this is going to be a good deal or bad deal, right? If your property is negative cash flowing, it's a bad deal. If it's positive cash flowing, then you can continue. The financing part is really, really important, okay? Now, you also have to determine if you're going to go with a conventional loan, like through a bank, or do something creative, okay? Which we are really good at with our company. I would say a good percentage of our deals that we close in our company are creative, okay? We love this type of financing for our students, and they love it too. All right, now here's what to put your eyes on in this situation. Okay, so when you're considering a loan, and part of your underwriting is to pay attention to the loan to value, or what we call the down payment. Okay, the lower the down payment, the higher your cash and cash is. Okay, so it works. You also have to take in consideration the interest rate. As you know, today they're pretty high. Now, and here is getting an interest-only option for a year or two a possibility. You should ask a lender because that just boosts your cash flow and it boosts your cash and cash return and gives you a chance to cash flow greatly out of the box. Okay? All right, number 2 is your amortization period. When you buy a single-family home, it's always 30 years. Not in commercial. In commercial, it can range from 15 to 20 to 25 to 30 years. And the lower the amortization, the lower your cash flow because you're paying the mortgage off, and the lower your returns, okay? So the lower your amortization, the higher your mortgage payments are. Got it? Okay? All right, and then really important is the balloon date, or when the loan matures. If you are planning to do a long-term holder for 10 years, but your commercial loan expires in 5 years, you need to rethink this loan, okay? And lastly, the prepay penalty. And when you buy a single family home, there's really no prepay penalty. You can pay it off anytime. Not in commercial. In commercial, most times there's a prepay penalty, meaning if you pay it off with the first year, that's like a 5% penalty. The second year you own it could be a 4% penalty, and so forth. When you do a larger apartment complex, the prepay penalty can be ginormous, making it impossible for you to sell the property. You may have to have the new buyer assume the loan. Okay, so a prepay penalty, knowing what that is helps you determine a lot of things about what you're going to do with your deal moving forward. Okay, which leads me to building block number 6. Okay, it will address exactly what's going on here. Let's do that next. Last but not least, building block number 6. And before I get started, if you enjoyed what we shared here so far and you have any questions whatsoever, you can text us to Peter at 833-942-4516. The number will appear right here. Ask us any questions about what we do with our students, how we teach them, or any questions on materials here, okay? We'd love to hear from you. All right, let's do number 6. Number 6, the building block is exit strategy, okay? Exit strategy is the way you get your money out of the deal, okay, eventually. Every property, when you underwrite, needs to have an exit, and we call that an exit strategy. Here are a couple examples. Let's say you want to buy the property and hold it long term. That's an exit strategy. Let's say that you wanted to buy it and by year 3 you wanted to do a cash out refinance and pull out your down payment. That's an exit strategy. How about if you buy it, fix it up, and then hold it long term? That's an exit strategy. And how about this one here? You want to buy it, you're going to fix it up, and then you're going to 1031 exchange it, and you're going to defer all the capital gains into the larger property. That's what I've done many times. It's a great way to build wealth. All right. So these are your exit strategies. Every property, when you underwrite, needs to have an exit strategy. Okay. And if you don't know how, again, if you have a question on an exit strategy, go ahead and text us and we'll help you out. All right. Now, here's what to put your eyes on. Okay. This is really important. I'll give you a quick example. Make sure your loan matches your planned exit strategy. Here's what I mean by that. For example, if you plan on doing a cash out refi by the 3rd year, okay, of owning a property, so you bought it, you fix it up, it's worth more money now. Now you want to pull out your down payment. You want to do this in year 3. Make sure that your prepaid penalty expires at year 3. All right. If not, if you want to get a new loan, guess what? You have to pay a prepaid penalty. All right. So planning your exit strategies is really, really important. If you need help with that, go ahead and let us know how we can help you with that. All right. Okay. I just shared with you the 6 building blocks of underwriting a commercial or multifamily deal. This will surely help you. All right. So just to make sure that you understand, this will help you make a more informed investment decisions. It's going to help you prevent making mistakes. It's going to help you identify the problems early on. All of that is so important when you want to analyze and evaluate a commercial or multifamily property. Got it? All right. Thank you so much. If you hung out this long with me, you are absolutely my favorite. So do me a favor, go ahead and like the video. That will encourage us to put out even more content. If you like the video, if you like what we do, you can subscribe to our YouTube channel. We would appreciate that. So everyone, thank you so much for hanging out with me, and I'll see you at the next video.